Welcome everyone to another OCP Tap call. This is call number 113. Today we have Francisco from Safran. And as usual with the format, Francisco is the Business Development and Sales Engineer Lead at Safran Navigation and Timing. He holds a PhD in Telecommunication Engineering from the University of Granada. After some time in the private sector, Francisco joined Timing Keepers group at the same university as a researcher. Doing his research, he specialized in ultra-accurate time transfer systems, and he focused on development of the White Rabbit technology. During the last few years, Francisco has led the expansion of White Rabbit high accuracy timing in North America market and in finance sector with Safran from Aurelia and Seven Solutions. His latest work involves the development of very long distance White Rabbit link and the integration of the HATI core in third-party FPGA-based devices. Today's talk is about the significance of accurate timing and synchronization in trading systems. And with no further ado, Francisco, the floor is yours.
Okay, thank you so much, Ahmad. So, welcome everybody. I won't reintroduce myself. I see some familiar faces on the people joining the call. So today I will be speaking mostly about time synchronization in finance, the different applications. I will cover why time synchronization is needed and how the finance market is structured, the different players and so on. So there will be some part of the talk at the beginning that will be kind of introductory, especially for the people that are already working in finance. Then I will move to the approach that we have when we are addressing the finance market, which is through this White Rabbit high accuracy time synchronization and some use cases that we typically work with people that I think are like great examples on how time synchronization is used in the market. So without further ado, let's get into this. First of all, short introduction on Safran. It's the company that I work for and the company that make us being here together. So time synchronization company, a multinational with, yeah, sorry, because I think that I have like an autoplay on the presentation. Give me 1 sec. Okay, I think it was only for those 2 slides. So multinational company, a lot of offices around the world. We have one department, which is the navigation and timing department, which I'm part of, where we manufacture solutions or we design solutions for navigation when we work mostly with, moving systems like airplanes or aircraft or boats or any other kind of platform which is moving, and also time synchronization with GPS based time servers and also distribution and atomic clocks that we manufacture in-house. In my case, I specialize on the timing part, time synchronization and time distribution, not that much on the atomic clocks, mostly on GPS-based time synchronization and the distribution using network protocols. So with that, let's focus on electronic trading. So one of the things that most people that are not in the finance industry doesn't know is that trading is not like you see in the movies, everybody in the floor just yelling at each other and picking up phones and putting tradings in. That's how it used to be. It's not how it is anymore. Most of the trading happening in the world is happening in trading networks, which are basically data centers with a bunch of servers where the stock exchanges are located and where the participants in the market are collocated. So everything or most of the tradings right now are um, electronic trading. When you are trading in a network, there are a few things that you can do to improve the outcome of the trading that you are doing. It's not anymore about, someone reviewing or personally reviewing the stats, or reviewing or reading the news and then putting a trade. Is a lot of that process is automatized. And the automatization of the trading is very important, because it's what gives you the competitive edge against other participants in the market, and allow you to actually benefit from market trends and make the most money out of it. There are four main things why time synchronization it's important when we are working in this. Okay, so I'm not sure if you're having issues hearing me. Well,
Hear you loud and
so
clear.
okay, perfect. Thank you. So four main things where we care about time synchronization. The first one is latency. So the one of the main principles in trading is that you want to be faster than any of the other people who are trading. So you want to react to market event faster. You want to be able to sell or to buy options or stocks or future faster than the rest of the people based on the information that you have. Because if you do it faster, you will get better pricing than the other people that will be trading over those same options. Okay. Then, as latency is a very important factor, what you need to do is optimize your network, which is performing the automated trading to be the lowest latency possible. So you need to measure that latencies to understand how your network is behaving and where you can improve the trading that you are performing. And also, you need to have some network visibility. If you don't see what's happening in your network, it's impossible that you are able to optimize. So that's where time synchronization has a role, because with time synchronization, you have an unique understanding or notion of time in the different parts of your network. And that notion of time is the one that you can use to measure the latencies between different parts of your network, which might be in a local area, in a colocation, just a few racks, or it can be in different data centers where different stock exchanges are located, or it can be if you are in a stock exchange, synchronizing multiple different access points that you have in your infrastructure. One other thing is regarding data quality. So I said that most of the trading is automatized, which means that there is an algorithm making the decision of buying and selling. And there is some machine learning, artificial intelligence applied to this. And the way you are able to feed those algorithms that are performing the trading is by feeding them market data. The data that you collect, the best you train the intelligence, the most intelligent, the more intelligent that it will be, right? It will have an improvement on the performance. So when you are speaking about latency, which is one of the main factors when you are trading, being able to timestamp with a very precise with a lot of resolution or accuracy improves the data that you are feeding the algorithm and that you use to help. At the same time, in cases where you need to perform some trading simultaneously, or some actions simultaneously in different locations, having the same notion of time in those different locations allow you to trade simultaneously. For example, imagine that you want to buy stocks. Those stocks, they are not only in one single stock exchange, they are in multiple stock exchanges. So one of the things that you want to do is sending your buy orders at the same time to the different stock exchanges, so no one goes and buy those stocks before you and give you a higher pricing. Imagine that you send an order and then you send the second order a bit later. Other other company can detect the stock pricing going up in one location and might get faster than you to buy those, get a higher price, and then sell them to you at a higher price. So you are losing some margin. That's an example of what a lot of high frequency traders tend to do in the market. Then regulation important. These are publicly traded markets. They are regulated, and you need to report the trading that you are doing. Have a bookkeeping of all the orders that you have, and one of the main things to consider is the time when all the trading happen. And lastly, resiliency. Mm, it's important. We all know about GPS jamming and spoofing and interferences in urban areas and everything. It's actually very important in a sector where almost everybody depends on GPS-based timing in different locations. But one of the particular things about finance is that people are very imaginative in ways to gain an advantage. And for some reason or another, the locations where you find the most GPS jamming and spoofing attacks tend to be where finance data centers are located. So if you check, for example, the city of London was back at the day one of the places with the most GPS jamming and spoofing occurrences in the world. So having a resilient time synchronization system, it's important because you will need that information to report, and because every time that your time synchronization is degraded, you will be losing information, or you will be collecting worse information, worse quality information that you will use later to train your algorithm. So moving into the basics, a couple of concepts. So we will distinguish between time generation and time distribution. So time synchronization, it's being able to distribute time between different locations, okay? So having different devices in your network to share the same time. We say that a time is traceable when it is comparable to an official source of time. So official sources of time will be national meteorology institutes in the world, or probably the GNSS constellations, GPS or Galileo. They are widely accepted as traceable sources of time when you are reporting to authorities. Most of the people in finance, they get time from GPS. There are a few examples of time as a services around the world, but in most cases, they are getting time from GNSS. That's what we call generation. Taking time from that GNSS constellation and get that into your location, into that data center where you are located. The thing about GNSS is that you need an antenna going to the roof, so you get access to the GNSS signals, and you can have a notion of time in the data center. From there, you always need distribution. And so you are not just providing time to one single device in the data center, you are providing time to multiple servers, to multiple switches, to multiple time stampers. So all of them will need the time that you are recovering or generating on the time server going to the rest of the hardware that you have in the network. And that where protocols like NTP, PTP, White Rabbit, or even PPS distribution, pulse per second based distribution, are playing a role in finance. So a little bit about the structure on finance, what we will typically find. Most of the trading, not all of it, but most of the trading is happening in stock exchanges. Okay, stock exchanges are centralized locations where you can buy or sell stocks. So they have, if to put it like in a simple way, they have the stocks in their servers, and they just change the name of the owner of those stocks. But the stocks tend to be at the stock exchange, which is trading those. That's a very simple way to put it. So if you are into trading, please be kind with me. We have in those centralized locations, we have the participants that are trading in the stock exchange. They are the people that want to buy or sell the stocks that are within that stock exchange. So these people, they are the ones that are actually set the pricing of the stocks, because they are the ones that are selling them at a price or buying them at a price. Their main concern is trying to execute any purchase orders or buy or sell orders as fast as possible. Okay. And then there is another kind of company which are called the market makers. The role of these kind of companies is typically provide liquidity in the market. So in some occasions, it might happen that when you don't have people that want to sell a stock, even if you place buy orders, you will never be able to buy anything, because if no one is selling, you cannot buy. So there are a few companies that what they do is buying and selling stocks to ensure that the market has only liquidity at all times. So these kind of companies, they don't really care about the pricing. It's not their end goal to buy a stock and profit from that, or what they are trying to do is, or where they make the money out is to enabling trading to happen between different companies. So they are sort of the facilitators. Let's put it that way. So on a stock exchange, and most of them share a similar architecture, looks more or less like this. This is actually a diagram I took from Eurex, the German stock exchange. So if we go in order, so we will have the participants, which are collocated in the stock exchange, and they will send an order to the stock exchange, either a buy or a sell order. That order will go through their access network, which is the network that is basically a number of switches that gives you a number of cross connects to the participants, where they are receiving the orders from the different participants, and they are aggregating that data and transporting that to the matching engine. In the access network, it is important a few things. You need this access network to be fair and to be deterministic. The reason is that you don't want to some of the participants in your stock exchange to have an unfair advantage in terms of latency when they are trading. You want everybody who is trading in your stock exchange to be able to trade under the same conditions. Okay, so in the access networks, typically you will find a lot of tapping and a lot of time stamping to ensure the order when the different mm, buy or sell orders were received by the access network. Okay. Once that you have collected the information of when all those orders came into your access network, you take that information to the matching engine. And the matching engine is actually are the servers that put the name and the price into each one of the stocks. Okay, so if I have this stock, it has this pricing and it has this owner. That, in a very summarized way, how a matching engine will work. In order to decide who is the owner of that stock or that product, whatever it is, the time stamping of when the order arrives, it's a very important factor. Matching engines typically work based on two different variables. The first one is pricing. So the highest bid always win. And when you have bids coming at the same time, then the fastest one wins. Okay. So in the matching engine is, if I have this stock, I don't know, IBM stocks selling at $20 per stock, and then I receive an order which is giving me more than $20, I will match this buy order with this stock or this stock that I have in my matching engine. If I receive at the same time two um, two orders to buy IBM stocks above $20, I will select which one of them is the highest price. And if both of them have the same price, I will decide which one of them arrived earlier to the match engine and to the stock exchange. That is how I would make the match between one and the other. Once that I have received all these orders to the matching engine, I need to report the data and I need to give an update on the status of the market, the ownership of the stocks and the price for the stocks to the participants in that location. So I will have the market data network, which is the output of the matching engine. Very similar to the access network typically in terms of architecture, but one of the ends is the input and the other one is the output. Okay. Most of the participants, for example, what they will be doing is they will be polling the stock exchange at all times. So they will be always sending a small buy or sell orders. So they receive the market data back from the stock exchange to understand what's the pricing. And when they detect a pricing that, or some kind of market event that they think that they can benefit of, then it's when they will execute their big trades. If we complement that with time synchronization, so we will see the first a boundary, which is then in the north part is the stock exchange, and in the south is the participant. So those are two isolated networks that have some cross connects going from one to the other. This is very simplified. Typically, they have redundancy and so on, but I won't get that deep on that. So the stock exchange will have its own clock reference, and it's the clock reference that they will use for all the time stamping that they need to do in the access network, in the market data network, or if they need some time synchronization for the matching engine or for any other services that they are running. Then the participant, typically they will have their different time generation on their end, mostly in most cases based on GPS as well. And they will use that time synchronization to timestamp their own, the switches that they have interfacing to the stock exchange, and also to synchronize, depending on the strategies that they are following. They sometimes trade based on ASICs. Sometimes they trade based on FPGAs in layer one switches, and in some other cases they trade based on the servers or even the NIC cards that they have in the server. So depending on where the platform which is doing the trading, they will need to synchronize there and to measure the latency on each one of the parts that they have in their network. One thing or one trend that is happening more and more in times in finance market is actually that the stock exchanges, they are providing time as a service to the participants. So they are sharing their own clock. There is a reason for that. If this clock reference is different than this clock reference, and we know that GNSS time servers typically have some excursions in the tens of nanoseconds level, the latency measurements from this point to this point will have the error of the two GNSS time servers that are creating the time in the stock exchange and in the participants. When you have time as a service coming from the stock exchange, you remove that noise, so you can have better metrics. This is sometimes complemented by stock exchanges providing some files on the capturing that they do in their networks as well. So it's a way for them, it's a service that they can provide a benefit from. And as I said, it's not just one location. So it's not one stock exchange and everything happening in one place. It's multiple stock exchanges. So we have financial hubs like the New York area, the Chicagoland area, London, where you have multiple stock exchanges in different data centers in a metro area distance. And there is a lot of trading, which is, or a lot of market events happening in one of the stock exchanges that are affecting the pricing on other stock exchanges and vice versa. So it's not just what happens in one location, it's what happens in all of them. And if you keep in mind that each stock exchange will have their own notion of time, and each participant in each one of the locations will have their own notion of time, and then they will have the error for the time synchronization to the different elements that they are using for the trading in their architecture. So it starts to become complicated, right? So you have a lot of errors and a lot of unknowns, things that the best, if you have the best time synchronization available, you will be removing some of those errors, and you will be gaining better intelligence on the market trends and how well you are trading, and the rest of the people are trading as well. So I will check the chat for a second in case there are any questions. So just a few comments. Thanks, David, for that link. Very interesting. So let's continue. Let me know if you have any questions at any time, okay? Feel free to raise your hand or whatever. So coming back a little bit more on time synchronization and the uses in trading. So I mentioned latency measurement. And so to give you a figure on how well you need to measure latency, we see typically like different windows of people, different windows of latency for the reaction to a market event in stock exchanges, okay? So typically there is one first wave, which is centered around 20 nanoseconds. That's 20 nanoseconds from the moment the stock exchange sends a market event to the moment the participants react to that market event. So it's 20 nanoseconds, very, very, very short time. In most cases, is trading happening in ASICs or not even FPGAs, because I don't think that, well, maybe some FPGAs can be playing in that league, but it will be still very challenging. So it's around 20 nanoseconds plus minus 10 nanoseconds variance. Then you have a second window which which I think is where most of the people trading on FPGAs are, which is around 50, 60, 80 nanoseconds reaction times. And then you have all the rest of the people that are like trading probably on the CPU level, or they are other kind of strategies that are not so reliant on the very low latency reaction to the market events. So that's a little bit different. But the point here is that if you are trading in 20 nanoseconds, if that's your goal reaction time to a market event, imagine how good you need to be when you are trying to measure the latency to optimize your performance. Okay. So, and if you have many different participants trading so fast, trying to keep or to gain the information of who is faster by how much they are faster than you, and all these kind of metrics that you can use later to train your algorithms, it's very important, right? So every time that you approach someone working on the high frequency trading industry, you are always too inaccurate for them. So there is no way to keep these guys happy, and you always need to provide more. And that's lucky for me. That what gave me a job during these last years in taking White Rabbit to finance. But it has been an adventure for sure, very challenging. As I said, all the information that you capture will have a direct impact on the training that you do. Okay, so having a incorrect latency measurement, imagine that you are trying to teach your algorithm based on time stamping that has an accuracy of uh, 5 nanoseconds. When you are in a wave that is, 20 plus minus 10, you have like a 50% uncertainty just on the timestamp. So it will be very, very hard to provide information to the algorithm, which is actually valuable and something that you can take advantage of. Then moving into the regulation, mm, this is something that in terms of time synchronization, if you check the numbers, 100 microseconds, 50 milliseconds for FINRA and MIFID, we know the people in the time synchronization community that this is not actually very, very challenging. It's not a high accuracy number. However, it's a high fidelity number. So you need to meet this number every time. Okay. So backups to devices like atomic clocks or per accuracy in the microsecond level that you can achieve probably with PTP or NTP implementations that have some hardware support are typically the kind of technologies that you will find to meet these regulations. A few things which are interesting is that you need to keep track of all the tradings for a number of years, and you need to prove that you are traceable to a real to a notion of time, to an official time scale, which is in most cases for these people, they are GPS or Galileo, the ones that they are using to back up their reports. And as I said, I mean, we know things happen. GNSS-based systems, they are subject to different threats. From intentional jamming, spoofing events, or interferences happening in the area to, just obstructed signals. Some of these data centers or locations that are in urban areas or that are close to metallic structures. All of those can affect the generation of time that you have in place. And so far, if you degrade your timing, you will degrade your capturing, and you will degrade your business at the end. So a few tips that I always share with with the people working in this market is things that you need to avoid is having a full dependency on GNSS in one single location. Okay, so that's probably the worst nightmare because GPS will fail without warning if it is affected by a jamming or a spoofing event, or if there is like any kind of interference in the area. And if you don't have any countermeasurements for that, countermeasures for that, like an anti-jamming GNSS antenna, atomic clock, or some kind of hollover clock that will back up you during the time the GNSS is not available, or if you don't are not distributing time from a different source that might back up that local reference, you are in a bad position. The very same that if you only have mm, in a regular network, if you had just one device, right? And you have one switch and all the traffic is depending on that switch, and then the switch doesn't work. So you are in a very bad position. You always want to avoid this kind of that kind of situation. Also, one of the uh, interesting things about timing is that time lapses. Okay, so even if you have one measurement of time, and that's the Seagal's law, um, if you have one clock reference, you will think that, okay, your clock is always correct. When you have two or more, you never know which one is correct. I mean, you just can kind of hope that they will come to an agreement, and every time, every second that later, you will need to measure again to certify that the time is still correct. So time lapses is not easy to ensure that time is correct every time. Okay, so that's something that you need to take into consideration as well. Uh, in that case, traceability is a good way to check, m- even more than traceability, having diversity on the sources that you use to synchronize. Having multiple GPS, using different constellations like GPS, Galileo, using time as a services or distribution from other locations. That's very, very interesting. And one last thing, and I will jump to the question that I see here, is the time synchronization, which is a very interesting thing in finance, is that you can actually benefit from it. You can make a profit out of a better time synchronization, which and is much more obvious in finance probably than in many other segments or other industries. The impact that you can make on your business based on improving the time synchronization. So, Victor, I see that you have a question, or you raise your hand.
Yeah, yeah.
Oh, sorry,
Victor,
wrong.
you have a question now, or you want to wait for the question session? Okay,
Uh,
let's wait for the question session. We have the questions at the end. Yeah, go ahead.
okay, okay, perfect. Yeah, I was hoping for a break. But so now that's concludes the generic introduction to time synchronization in finance. So now I will move a little bit more on my personal experience when I've been approaching this market. I will try to avoid this becoming a marketing kind of meeting, but I want to explain you a little bit what's the approach that and the experience that I've had with these people, and show some of the examples why people have approached our company, because I think those are good examples of why time synchronization is important as well. So, as we said, we want the best time synchronization. People in finance are very competitive, and they need the best. We have what we call accuracy, which is um, the degree of correctness of the time synchronization at a specific time. So imagine if you have two clocks, you want the two clocks to have the same time, and any offset between them, that will be the accuracy. However, time lapses over time. So every time that you check the time, you might have different offsets, different accuracies. That what we call the precision. So it's the correctness over time. Okay, the degree of repeatability of the measurement that you have. You always want to be in the high accuracy and high precision sort of a scenario. You might in some cases work with a low accuracy, high precision scenario if you can post-process and remove any offset, static offset from the metrics. But what you don't want is a low precision scenario because it's very difficult to correct or account post-process this kind of noise later. So what we did, or the way that I came to the finance market was through the White Rabbit protocol. So the White Rabbit protocol is a network protocol based on PTP, which main goal was to achieve sub-nanosecond accuracy and precision in the 50 picoseconds, plus minus 50 picoseconds range. Okay. So this is a protocol that was born for particle accelerators. We, in a random conversation with a member of the particle accelerator community, we learned that he was approached by the German Stock Exchange. This is almost 10 years ago. He was interested on getting better timing. So we started working with them, with the German Stock Exchange, which became the first adopter of White Rabbit in finance. Um, the Their interest was basically improving the timing that they had back at the day using PTP to synchronize their network. Pulse per second distribution, which was back in the day very typical in networks, finance networks. So White Rabbit is a protocol, so it goes over fiber. You don't need to calibrate the same that you will need to do with PPS, and it gives you better accuracy than what you will achieve with regular PTP or NTP implementations. With time, White Rabbit has been also evolving a little bit. The first approach that we did was mostly because of the sub-nanosecond accuracy and the precision. From that uh, from that beginning, like local area, sub-nanosecond accuracy, we have been working to move White Rabbit to longer distances, to provide network resiliency, being able to interconnect different locations without degrading the time, monitoring how well the time synchronization work, or even integrating these capabilities in hardware that is finance specialized hardware, which already support native White Rabbit capabilities. And this is a little bit how the portfolio will look like. Fairly easy. A time server, which an option for a White Rabbit card that can distribute White Rabbit over optical fiber to a multi-port White Rabbit device to very similar to a switch in a data center, just to fan out and to deploy three topologies, scale on the number of units. And then and nodes, depending on what you need. If you need PTP, NTP, or if you need pulse per second signals, you will have different formats with different number of outputs. So in the case of White Rabbit, a few use cases, when we speak about the stock exchanges, which was the initial um, case that we had. So improving the accuracy in one site and also between different sites is important. The failover between different GPS references that you have in the network, or in many cases also, even when you see a lot of equipment that already supports PTP, that equipment, which are typical switches or NIC cards, they are also working with the data, with the market data that you are using to trade, and having the integration of timing over those same networks might affect you negatively in two ways. It can increase your latency, which is a problem because you will be trading um, slower than the rest of the competitors. And also the fact that you are sharing the same network for data and time synchronization might degrade the accuracy of the time synchronization that you are performing. So simplifying these PTP networks with a backup, high accuracy time synchronization network running in parallel is also one of the approaches that we often find. And as I said, enabling some networking devices that are used in trading to support White Rabbit. It's also kind of injecting that high accuracy synchronization directly to the infrastructure that you use for trading, which is something that before was mostly based on PPS. All with the aim to improve the time stamping capabilities that you have, and also the coordination between the different sources. This, of course, can be extrapolated to metro area and even longer distances. The very first results that we got when we made White Rabbit run in the German Stock Exchange was a 100 times improvement on the capturing synchronization that they were doing on their on the switches that they had in the access layer, in the access network. So that gives you a hint on how a better time synchronization can improve the metric. I won't discuss that much about the different alternatives. We all know GPS. I already introduced that. Great technology, free, but you need an antenna. So it's a generation, it's not a distribution. Then once that you have that clock reference, you need to provide it to different locations, and you do that with protocols. NTP, either fully software or with a hardware support, is mostly used for generic tasks that require timing, um, mm, bookkeeping, human readable kind of timing, all this sort of stuff. PTP is typically used for devices or systems that need a good timing, but they are not the most exigent, or probably they are being run on an operative system or platforms that they don't have support, or they cannot support better time synchronization. And White Rabbit, it's providing this sub-nanosecond accuracy, but it's typically for devices that are based on FPGAs or have pulse per second this, synchronization available, because it's targeting like the best level of accuracy. So each solution has its own target. You don't need White Rabbit everywhere. You don't need White Rabbit to servers that are just reporting time to users, to human users. That's probably overkill. The same that you don't want NTP to try to synchronize the FPGA platform that is trading with 40 nanoseconds latency. Okay. So the thing about White Rabbit or the devices that we have, they're White Rabbit. They are time synchronization devices, so they support PTP. We do the conversion to pulse per second, and we also support NTP. So doesn't need to replace all the timing network that you have, but you could do it if you want. You could interconnect different locations. Regarding the proprietary trading firms, that's quite interesting, and I think that I will highlight one of the main use cases that we find lately, which is interconnecting different stock exchanges in financial hubs. You have a triangle, typically my New Jersey triangle, three locations. You have Nasdaq, you have the New York Stock Exchange. You have this Equinix campus with You have CBOE, you have MAIAX, you have some others in the area. And what you want to do is having a single notion of time between all the different locations and being able to back up if you have GPS receivers in the different data centers that are miles away, one from the other, backing up your network with those antennas, especially and also in times in data centers dedicated to finance. One of the things that typically happen is that it's not so easy to have a GPS antenna in the roof. Some of them they have run out of capacity. Some others are quite picky on the requirements that they have, and some others they are just very expensive. So minimizing the number of antennas that you have in certain locations and distributing time over the fiber, especially in these areas where there is a very high connectivity with optical fiber, it's an use case that you find out with proprietary trading firms. For
Francisco,
for
you
it,
mind if I ask a quick question on the previous slide, just for clarification?
yes, go ahead.
Thanks. I appreciate it. So on this slide, I'm assuming that White Rabbit is being used here purely for time, meaning, in other words, the trading data is going over a different network technology. Is that correct?
Yes. So
Okay,
it's a
thanks.
timing only network.
Okay, thanks.
You don't want to mess with the latencies with the market data network. So that's one of the main things here, which differs a little bit on the typical approach that you will find in data centers probably, where they have the capacity, they don't need that very low latency, so they might want to get timing to run over their same data network just to avoid having this overhead of parallel time synchronization network. So still in the data center, but a different flavor, okay? For stock exchanges, as I said, probably I will highlight these cases where they need to be fair, they need to timestamp everything, they need to ensure that they are providing the same conditions to all the participants. And what it's the way they are taking advantage of White Rabbit is mostly by offering the data that they capture and the time as a service based on White Rabbit distribution to their participants. So they are actually using time synchronization to make money out of it. It's something that they needed because they needed to keep track of how they were trading, and they needed to justify that they were fair, and they found a way to make money out of it. So that's an interesting thing as well. So last to some case studies, I already mentioned the German Stock Exchange first integration that we did with White Rabbit. You can see that back in the day we were still working with the White Rabbit switches, which are part of the open White Rabbit community, and you see the naming on 7 solutions. So a few years ago. In this case, we started synchronizing more than 60 capture devices in 4 data center models, which were accounting for more than 500 capture ports. And we were doing that, feeding pulse per second signals to the Arista 7130s, which are layer 1 switches that come with time stamping capabilities. With that, the German Stock Exchange developed these 2 products. One, which was the high precision timestamp file, recollection of all the data that they were capturing in their network, which they will sell to the participants, and also a time as a service to synchronize the participants' infrastructure to the stock exchange infrastructure. A second use case was with the Spanish Stock Exchange. In this case, a little bit different. The Spanish Stock Exchange had 2 locations around the Madrid metro area. One mostly for survivability, and another one for most of the trading. What they needed to have is a backup to a timing backup to the different data centers. So what we did in this case was sub-nanosecond synchronization in a metro area link, and also rollover capabilities on the White Rabbit devices that you will have in each one of of the locations. So it's short-term holdover, 24 hours, and in most cases that's more than enough to comply with the needs that they have. You don't typically find GPS outages longer than 24 hours. And still, as they have, if they are looking for reporting and similar, as they have this 100 microsecond level of target of accuracy, it actually can run with not so very expensive holdover oscillators for weeks before getting out of there. Another case study, this one becoming more challenging. In this case, with Optiver, a market maker, they wanted to synchronize their locations in New York and their locations in Chicago using the same link. So we deployed a White Rabbit link, very long distance. This is the longest White Rabbit link deployed that I'm aware of. We ran a couple of experiments. One which was a loop back from Chicago to a first location somewhere in Ohio, and then back to Chicago. So we could compare locally with a time counter. And we think that accounted around 800-kilometer distance. And it was like a first stage to validate that the optical transport network was okay. And we could see the sub-nanosecond accuracy. Then we completed the link we did a measurement based on the GNSS reference of New York against the GNSS reference in Chicago. And we saw that we were outperforming the specifications of the GNSS receivers themselves. So we understood that the influence or the degradation of the White Rabbit synchronization was pretty low. So imagine being able to correlate data from two very distant cities with nanosecond level accuracy. That's a major gain for them. Then a new use case study that we have is regarding survey measurement. So as I said, in many cases you have a part of the network which is optimized White Rabbit, very high accuracy, and you have some other parts of the network that are PTP based or they are NTP based, and you want to measure the offset between them. You can also have a scenario where you have these two locations with different GPS and you want to measure the offset between one GPS and the other. So the survey is a tool that measures the offset from your active clock against any other source that you feed to the device. So for example, in this one, imagine this link is the active one, and then you can have like 3 of them to measure against. And we can do that thanks to the accuracy of the White Rabbit devices, maintaining the picosecond level measurements that we will offer with White Rabbit. But you can use them also for measuring PTP links, NTP links, pulse per second, and 10 MHz links coming from another GNSS receiver. So it's a nice tool to measure and also in some cases to synchronize the delays between different GNSS time servers. The integration of White Rabbit, and I think this is almost the last one. So integration of White Rabbit in capturing devices. When you have FPGA-based devices where you typically do the time stamping and you synchronize them using pulse per second inputs, the first thing that you need to do is actually synchronize the FPGA to the pulse per second input that you are receiving. When you have White Rabbit capabilities in the FPGA, you can already synchronize the FPGA. You don't need to go through this PPS synchronization part. You can just plug the optical fiber and the FPGA where you are doing the time stamping will synchronize with the sub-nanosecond accuracy. So there is an improvement on the accuracy, and also you can get rid of all the calibrations that you need for coaxial cable PPS distribution. And that take me to this is the last case study, I think, which is for this is for a stock exchange, which I won't say the name. So they were concerned about people tampering the optical fibers, like trying to capture their fiber or adding some extra fiber to other participants. And they wanted to timestamp the time of flight and the propagation delay on those fibers. And we could do that with the white right devices based on a loopback. We will have a reflector on the other end of the fiber, and we will timestamp both when we will transmit and receive, and measure the latency of the link with picosecond level accuracy, and report that in real time. So another interesting application, which shows the level of precision that they were looking for. In that case, they had a requirement of 50 picoseconds. So very, very challenging. And here, just a few additional resources online that you can check if you want to read a little bit more about it. So any questions on any of the case studies or anything of the things that I have
Paul
explained?
has a question. Paul, go ahead. You're muted, Paul.
Sorry, I pressed the wrong button. Okay, can you hear me now?
Yes.
All right, good. So on slide 11, you see a main peak followed by smaller peaks. It's possible to imagine engineering causes based on the network, but is there something else going on here? For example, it looks like side lobes in an interference pattern.
So this is the one that you are referring,
yes.
right? So there could be, to be honest, these are not like, this is a representation of a specific event. So it's not like a trend on how the stock exchanges are behaving. And if you check this graph from the different stock exchanges, you will see different things. Okay. And so it's not very easy to say yes or no. I think that there are different categories, mostly because of the technology that they are using. The people using ASICs will be very fast. The people using FPGAs, they will be a little bit slower. And then you will have the people trading based on, CPUs, and they will take even longer. Depending on how optimized they are, you will see like 3 main waves, but those waves will have their own dispersion. The first wave tends to be very, very similar because it's based on ASICs. So it's the delays that they have in the electronics and the physical path fibers connecting to their cabinets.
Excellent, thank you. My final question is a short one. I assume you've incorporated the relativistic drifts in your calculations, and I'm imagining how this works, but have you considered indefinite causal order?
I haven't. In this case, I mean, these metrics are they are not mine because I don't operate a stock exchange, so I wouldn't have access to those. These come from a publication that the German Stock Exchange did for one of their presentations. So I basically took the data and I graphed it, but it's I don't think that they considered that for that graph. I think that they were only trying to show, how fast people react to market events. The tick to trade, how it's called.
Okay, thank you.
All right, David, do you want to explain something? Like you're putting it in text, maybe you can explain it as well.
Oh yeah, so I've worked on a similar project where I was at one of the exchanges doing this. Depending on where they're applying a timestamp, whether it's start of frame or end of frame, sometimes some of these lobes are actually a function of the message type. So if someone's sending a new order versus a modify order versus cancel, each of those will have a distinct packet length, and then that can actually show up in these distributions as well. And then you can get other things too, just like sometimes it is the technologies, other times the cable lengths are not exactly the same, despite what the exchanges say they are. They may not get the taps right or other things. And then some of it, I wouldn't be surprised if it's measurement error in some cases, because some of the places that provide this, they'll also even say in their own raw data that they're seeing samples that are supposedly impossible. And then they'll just sort of have a red line where they cut it off.
Right. Thank you. Hisham.
Yeah, Francisco, do you plan to demo this stuff in the upcoming OCB summit?
So the idea is that we will be demoing a couple of White Rabbit devices using a new SFPs that we tested in collaboration with Meta and Julian. So I hope that we will have those in the Experience Center.
Yeah.
Okay, thank you.
Any more questions? All right. We are already 7 minutes. Oh, is there anyone? No? Okay. So, yeah, so we'll see everyone in 2 weeks then.
Yep.
All right.
Thank you so
Bye,
much,
everyone.
guys. See you around.
Thank you.
Bye.